Ladies and gentlemen, welcome to the Business Brew. I am your host, Bill Brewster, as always. This episode features Dylan Marrello. I found Dylan through the Twitter machine. He was posting a lot of interesting ideas. And when I say interesting, I mean things that I don't see people talking about all the time. This particular conversation is going to talk about a lot of companies that I do not follow and don't have any expertise in, but what I liked about Dylan's approach is when they said, hey, Mr. Buffett, if you had to generate 50% returns or whatever, what would you be focused on? And he said the nooks and crannies of the market. I think Dylan is focused on the nooks and crannies of the market. I have not seen his returns. I don't know if he has any audited returns. I just think he's an interesting guy to talk to. So should you find this conversation interesting, feel free to follow him at ragingbullinvestments.substack.com. I think that could be something interesting to take a look into, some of his ideas. These are microcaps. These are small. These are my perception of the riskiest thing possible for a naive investor to get into. So do not listen to this conversation and go out and make any dumb financial decisions. Also, we talk a little bit about Seaport Entertainment Group. It's a spinoff of Howard Hughes. We talk about why Bill Ackman may have backstopped the rights offering. A subsequent conversation with my man Francisco brought out the point that I should have thought of at the time, that backstopping the rights offering increases the probability that the rights offering gets done because it gives people confidence that the money will be there. So that's obviously a component to this. I didn't mention that and mention it now. Anyway, this intro has gone long enough. As always, none of this is financial advice. Do your own due diligence. Please consult your financial advisor before making investment decisions. All of this is for entertainment purposes only, and enjoy the episode. Before this music drops, I do want to give a shout out to my editing team at Speech Docs. You can find them on Twitter at Speech, and Docs is DOCS. Dax and his team are fantastic. I moved from the podcast consultant to Speech Docs, and the transition has been, I would argue, seamless. All I can say is that Dax and his team offer incredibly good value, and they're very responsive, and I very much appreciate what they do on the back end of this show. So if you are somebody who is thinking about starting a podcast, please consider Dax and his team at Speech Docs. That's SPEECHDOCS. Gentlemen, welcome to the Business Brew. I am thrilled to be joined by Dylan Marrello this episode. I found Dylan through his pseudonym on Twitter. He is on the Twitter machine, and found him throwing out a lot of ideas that I don't typically see on Twitter. You see a lot of tech-focused, compoundery type ideas, and Dylan, you see him a little bit more special sit/asset-based, I guess, if I were to summarize what I've seen you come up with over the last, call it 7 months or 8 months or so. So anyway, thank you for saying yes to coming on.
Well, thanks for having me on, Bill. Appreciate it.
You want to give people a little bit of your background?
Yeah, sure. So I am somewhat of an unconventional background for where I've arrived at, although perhaps less conventional these days. But I went the law school route kind of as purely as one could do it. So I did undergrad law school, then I clerked at a court of appeal. I got a job at a New York law firm as a commercial litigator, and pretty quickly thereafter realized that was never going to offer me the lifestyle that I wanted. And by quickly, I mean like on day one. And
you didn't the lifestyle of constantly being on call and having to work all the time?
Exactly. And like, if you're not fully passionate about the work it entails, then obviously that's not manageable. The nature of the profession is such that you kind of get trapped, right? Like you've done all this work, you're incurring debt, then you get a pretty nice paycheck. And so it does take a little bit, it's a bit of a challenge to get out, I would say. So pretty much early on in my litigation career, I already kind of pivoted my mind to being like, well, what is my best exit from this? And I had had an investing interest dating well back before that. Like I did do some business school classes and I had an economics degree in my undergrad and whatnot. And so like my mind had already been on the subject of investing a little bit kind of in the decade that passed while I was an attorney. But kind of in the latter years, I really started to pick it up and get deep into it and then put myself in a position where I was able to quit the legal profession entirely, which actually was a recent decision. That was January of this year. When I fully,
How was that?
honestly, I had no regrets at all about it. Honestly, I wasn't fully sure what was going to happen, and it's snowballed. I mean, into being on this podcast 8 months later, right? But there's been a lot in between. It was an exit in January, and I had some investing success on my own for the years that preceded it, which was kind of what enabled me to leave. But sort of at the tail end of that, I started the Substack, which I've been working on, and that got traction relatively quickly, kind of through Twitter. And that has just kind of compounded into this, right? And so now I'm actually at the sort of back end of starting a small fund, which is launching within the next 6 weeks, probably. And so, yeah, it's happened really quick. And as I was kind of saying to you before we hit go on the recording here, like I launched everything with anonymity, largely for the purposes of kind of having enough confidence and also letting the ideas sort of speak for themselves, right? And so launched a Twitter account with the pseudonym. And I think because my background was completely in the dark, it really like led the ideas to getting a lot of attention because no one knew who the author really was. I mean, a lot of people obviously do that on Twitter, but it kind of helped me position myself to get to where I am now. But yeah, and now it's just completely full-time, although it's sort of been like this for a couple of years, I'll say. And by that, I mean just constantly looking at ideas, doing investment research, running my own account. And obviously the fund's going to be pretty small at launch, so I'm not expecting all that much of a lifestyle change from the last year or so. And we'll see where it takes us. And obviously there's definitely another angle when there's some other people's money involved.
Yeah.
But given the mandate and the size of the fund, I don't think it's going to be that much of a change at this point.
Is there a market cap you like to play in, or are you pretty agnostic?
Definitely smaller, but I'm definitely not one of these guys who's like only the most illiquid tiny thing possible. Although there are things in my book that are sub 50 mil and quite illiquid. But there's also some 1 to 5 billion market caps. Not really anything bigger than that, although maybe like occasionally they'll grow into something big.
Yeah,
And
I saw you on Spotify, but that was a one-off.
That was, yeah, I mean, when I was buying Spotify, which has actually turned out to be a pretty big home run, but it was trading down at like 75. And I think the market cap was maybe 15 billion. So
Yeah.
and it just kind of had a quirky angle to it, but it's not usually where I'm looking. The thing that's enabled me to kind of get to where I am, because this seems like pretty trite, but there are a lot of undiscovered and overlooked things when you go small. And for someone who's willing to put the time in and turn over the rocks and be on the, I probably spend way too much time on the computer, frankly. But if you're willing to do that, there are certainly things out there where you can actually get an edge. And given that the size of the account I'm running is not prohibitive, it makes sense for me to fish there right now.
I guess when I hear market caps that are that small, one of the things that I like to say, or that I like that you said, is you said, I'm not one of those guys that'll only fish in that pond. There's sometimes I'll read a pitch on a micro cap and I'll be like, does this person like this because they like it, or do they like it because it's a micro cap? And
Yeah.
I think sometimes the micro cap mind can see things that are not there simply because things are small. And it's like, I don't know that this is really any better value than something large.
I kind of completely agree with that. And you also get into a situation where you might just not have any incremental buyers for it. So I do think there is a sweet spot when you start getting from the 500 mil up range where there's more liquidity and there's just kind of, there's more of an angle in which you can get some momentum in the stock. Although if you do get that in something very small, it can obviously go parabolic, right? So
Yeah.
it's a trade-off, but I don't really orientate myself with those kinds of parameters when I'm looking at ideas, right? Like it's not so much like size or liquidity. It's more of like a mental model that I have, which is when you're learning to invest and like studying value investing, there's this sort of dichotomy, if not contradiction, between like the sort of Ben Graham-y net early Buffett stuff and then the stuff that Buffett kind of did post Munger, which I think is it creates some tension for value investors. And some guys are like, I'm deep value, and other guys kind of, as you said at the outset here, are kind of looking more at compoundery sort of things. And what I try to look for in the ideas are things that perhaps can offer some harmony between that tension, right? So if there's deep value and some kind of qualitative aspect, which is really interesting, for example, like some competitive advantages, a big runway. Now, the only time you really ever find that bridge between those two ideas is where there is like some profound misunderstanding as to what's going on at the business, which is kind of why I end up in small stuff, because you're just more likely to find the qualitative aspect of the investment being overlooked, right? Like anyone, for the most part, can look at the financials and tell you this looks cheap, right? But then the question becomes, like, what's the insight? And so you get a lot of that either in small stuff or then the other angle, which you said at the beginning is sort of hard assets. And I don't know if it's so much that I'm looking for hard assets as much as hard assets maybe have somewhat gone out of fashion for investors.
I think there's some truth to that.
And that's maybe what's leading me to investing down that road, right? It's not like I'm necessarily after hard asset investment, like I do have some super asset light things, but I think just because of the dynamic in markets, right? When you get that real negative sentiment is where you can sort of find that opportunity where there is deep value with quality, right? And I know, like, we've talked about this before, but some of the real estate names, right? And I know you had a series of podcasts about that, but
yeah,
you know, there are some real estate.
Well, that was multifamily. That's kind of easy to get your head around. I mean, then you get into office, and like, the deep value guy in me loves office. The part that recognizes that I don't do office as a specialty tempers my bias towards liking things that are hated. But like fundamentally, and I don't think this is a unique thought to me, but like, I remember millennials are not going to move to the suburbs, and I remember malls are dead, and now office is dead, and I've seen too many narratives on real estate be wrong to be like, oh yeah, for sure.
Yeah, I think that's right. And so you're fading like what I think is a raw consensus, but there's also I own three publicly traded real estate companies, and all of them, I think what makes them particularly interesting is that they have an office component, but they're also not just office real estate companies. And I think just a touch of the exposure to office is enough to put people completely off the idea.
Yeah, I do too.
And so there's been an opportunity in some names, I think, to buy some really high quality multifamily offices or some multifamily real estate with kind of a call option on the office portfolio working out. And that seems to be working really well so far. But
yeah,
it's early in the game and maybe I'm wrong, but I like what you say about there's always this kind of narrative around an asset class that turns out to not work out, right? And so I think
that's right.
As we get some polarization, office probably does all right, especially if rates start coming down.
Yeah, I mean, like, there's clearly crappy office and there's clearly oversupplied office, but I guess my bias would be that I've seen enough people say things like, yeah, I like this idea, I like this stock, but I can't own it because if it goes down, my clients are going to call me, and I can't say I lost money owning office today. I'd rather just wait for it to turn. And I think there's some merit in that, right? Like,
yep.
The pro side of that is you're not buying falling knives that, kill you. The upside is, or the downside is, I do think it distorts behavior in ways that are not business-like.
Yeah, and I've like up to this date, pre-launching the fund, I've not had to deal with any incentives like that, right? And even once this vehicle gets going, I hope that I've established the right narrative with the LPs that like we are going to be trying to do things differently and not have the kind of compulsion to follow the masses, right? Like if we lose money on an office, so what? Hopefully on net, those contrarian bets will end up paying off, which I think they tend to do. And as you say, you can't just go out and buy every office out there. Some of them are not good, but that's kind of the point of stock picking, right? Like if you're going to go identify something where there is a broad negative sentiment around the entire asset class, but inevitably there are going to be some that are really strong, right? So in each of the three companies I know, I think there's just a broad-based disregard for those kinds of companies, which causes people to not actually look very closely.
Yeah.
And two of those three companies are not microcaps, right? I mean, they're more in the small cap range. They're liquid. People know about them, but I just don't think people are willing to look at them. And also, it's funny, I spoke to Bill Chen recently, who I know has been on the pod, and he said something which struck me, which I think is definitely correct, which is that it's a lot easier to see the value in these names when you weren't watching them go down precipitously, right? So I never lost money on these names on the way down. I was up looking at REITs post 2020 when they started collapsing. And so I think when you can come at it with fresh eyes, it can be a little bit of an edge there. Whereas I think if you were looking at these names, not even necessarily involved, but just watching them fall, you might be thinking, well, I thought that was attractive then, and look what happened, right? And so you can get in your head a little bit. So yeah, I think that's kind of helped me maybe get ultra bullish on this kind of stuff. And who knows, I could be wrong, right? But I do find that a lot of the kinds of guys closer to the real estate industry tend to be more skeptical. And I think that's because of what's happened recently, right?
Yeah, and I think there's a few guys that I follow, and I think they've been through 08, 09, and I think maybe one of the better pushbacks that I've heard is this is really just a rates play. I don't know how much of that is reality in any given circumstance. Probably the asset class as a whole is. But there's some guys I think that have some valid pushback. But I think the general consensus, I'm not sure I buy into.
Yeah.
Which, to your point, goes to hopefully goes to the stock picking ability, right? Try to not own Class C office in oversupplied markets.
For sure. Yeah, there's supply constrained markets with quality assets, and there's buildings that are pretty clearly trading at a big, companies trading at a pretty big discount to their asset value. But the baby's just been thrown out with the bathwater, right? So I've spent a lot of time there, and that's just the real estate side, but it is kind of a broader thing that I'm trying to do when I'm looking for ideas, which is honestly pulling up the stock charts of the sectors and being like, this looks ugly, what's happened? And figuring out if that makes sense, right? Like another sector that I've spent a lot of time writing about and have a decent chunk of my portfolio invested in is actually cannabis, which is probably the most hated. Those companies, if I even bring them up, people start laughing. Like they don't even want to hear it, which gets me interested, right? Because when people, I own one cannabis company that trades at net cash, and it just grew its revenues 40% year over year, and it's cash flow positive. And these are Canadian-based companies, and there's this really interesting dynamic there, which is that there's an excise tax that gets charged on revenue. So on the top line, you're paying a tax. And when that tax was initially contemplated at the legalization of cannabis in Canada, so going kind of back to like 2017, 2018, they priced it with the idea that cannabis would go for about $10 a gram. And so basically the tax is the lesser of $1 or 10%.
Okay.
What's happened is cannabis prices have collapsed because of a flooding of the market. right? It's a classic capital cycle. And so you've had what people expected to be $10 a gram go down to like $5, $6 a gram. And the problem is you're paying $1 of tax on maybe a $5 or $6 sale. And so it's eating up a huge chunk of the top line of these companies. And notwithstanding that really punitive tax that they have to deal with, they're starting to make money. And so you kind of start thinking, these are pretty robust companies that are able to, still eke out a little bit of a profit when they're losing a third of their revenue to the government before expenses. And what happens if and when the government gets some reason and reforms that tax, right? Like which has already been tabled before the parliament in Canada. And so I would say it's ripe fruit for a new parliament to reform, in which case these companies will immediately start gushing cash, right? And so, but you look at these things and I think they're pretty quality businesses. Like they've established a big brand power. What's kind of interesting about some of there's actually two specific, it's called Organigram and Kronos Group, and both of them have major shareholdings by the big tobacco companies.
Yep.
And so that gives them a huge competitive advantage, right? They have a much, much lower cost of capital because if you're a cannabis company without that, you're not really able to raise in the capital markets. And you've got the existing distribution networks. So I think they're pretty good businesses, but, they trade at cash. And so I think that's another example of sort of what I'm looking at.
You had said that the tax was the low. I think you said, I don't mean to put words in your mouth, but I think you said the lower of $1 or 10%.
Yeah.
I think you meant the higher, right? Yeah.
So
Yeah,
anything below $10, you're paying $1.
Yeah.
Anything
makes
above,
sense.
you're paying $100.
Yeah. Yeah, I don't know. I mean, I dabbled in the cannabis stocks. I owned a lot of the collapse, which was super fun, but thankfully it wasn't a big position. But
Yeah.
I guess the thing that has made it tough for me in the States is I used to think that the retail distribution would be a durable advantage. And I'm not sure I still believe that. I'm not sure I don't, but I'm not sure I do. So it's one of those things that's kind of tough. I just kind of wonder if it should have been in my too hard pile because I still can't quite answer that question.
I've sort of taken the opposite approach, if I understand what you mean, which is that in Canada, the retail distribution and production are held by different companies, right? Similar to the alcohol industry in the US. And I do think that specialization is actually a competitive advantage rather than having a manufacturing segment, a retail segment, a distribution segment. I think particularly in the US, right? Because as if you were dabbling in the sector, you're not able to really expense yourself at this point. So
at all.
Spend, there's nothing, right? And so you're really constricted and you can't operate across interstate lines. And so I think it's created, and this is part of kind of the larger thesis with the large Canadian producers, is that I think the American cannabis companies have been sort of artificially constricted in the way that they've developed. It's just not, a business doesn't organically develop such that they can't touch another state and that they kind of have vertical integration like that. And so I think when the time comes, right, because these Canadian producers can't operate in America right now. And the reason that BTI and Altria have taken the position in the Canadian companies is because it would jeopardize their US listing and I think have a full host of other legal issues. And so what I think happens is when the time comes in the US where there's rescheduling or legalization, I think the big tobacco players are going to try to position themselves in cannabis through these Canadian-owned entities. And because there's already a pre-existing infrastructure by the tobacco companies in the US, that might just instantly give them a competitive advantage vis-a-vis the MSOs, which are operating within single state lines and don't have that infrastructure built out. So that's kind of like the larger picture thinking there. And that might never happen and could be down the road. But I do think that's sort of the mega bull case with these companies, is that they get positioned through the big tobacco companies in the US and take the market. And I sort of have a sense that over time, and this is, I think, where the bulls and bears in cannabis really differ, which is like, yes, it's a commodity, and so maybe you're going to have this sort of inherent cyclicality. But in another sense, like, you don't get that with tobacco and beer, for example. You have what is more an oligopolistic structure dominated by brands, even though the underlying product is somewhat of a commodity, right? Like, does it really matter if you're drinking Budweiser or Miller, right? Like, maybe marginally, but at the end of the day, it's just kind of an okay beer. And I think people are sort of paying for the brands. And so you might get a situation where there's price rationalization just because there's maybe 4 or 5 players doing all the cannabis in the country.
Yeah.
And who better to do that than the tobacco guys?
Well, certainly to the extent that you want C-store distribution.
Yeah.
Right. Yeah, I mean, like, the branding in Florida is non-existent because it's all medical, so everything has to be in, like, a white container. Although they've started to kind of brand some edibles, but nothing like out west.
Right. Yeah, I'm based in New York, and I don't think I've said it on the recording, but I'm initially from Canada, and so I've seen the dispensaries in Canada versus what's on offer in New York. And what I will say, and what I find really interesting, is that Canada-wide, you will see domination by certain brands already within the dispensaries. Whereas I walk into a dispensary in New York and there is just a multitude of products that don't really stand out to anyone. And there is constant turnover of inventory. Do you have something else in there next week? And so I don't think, at least in New York, and I would assume it's kind of true throughout the country, is I don't think there's really been much development of real brand power.
Yeah, I think that's right.
And to the extent you want actually economic profits in this industry, I think you're going to need to establish brand power. And I think that's more easy to do through edibles. Like, the example I sort of give people is, and I have spoken to some older folks in Canada about this, right, who maybe they didn't grow up consuming cannabis, and now that it's been legal in the last 5 years, they sort of opened their mind up to it. And there's this underlying fear that maybe I'm going to get too high or get the spins, or I don't know what it's going to do to me. And so there's an apprehension about consumption. And what I found that happens is they try a certain brand of edibles and they say, this one makes me feel actually pretty good. And because they've now gotten comfortable with that specific brand, they just keep getting the same one every time, right? Because they don't want to take the risk that another product is going to give them the spins or whatever. And so
Interesting.
By nature, it kind of has that inherent tendency towards a brand, at least in the edible space, because you are sort of at the whim of the producer. Right? Nobody wants to get sickly high.
No.
And so
edibles are a train that once it starts, you can't hop off.
Exactly, right?
It's not one that you just say, okay, I'm done.
Yeah, exactly.
Yeah, I don't know. It's very interesting. I think that the people that own Glass House would argue that in the U.S., this brand stuff is too hard, so just go with the lowest cost producer that can do it at a decent price. I think they've done pretty well off the bottom, certainly not off the top, but nothing did in that particular space. That may be another one where people are so hurt they don't even want to look.
Oh, I think that's for sure, right? Like, so turned off by it, right? I mean,
that's a SPAC that actually did okay, Glass House. Interesting.
Yeah, some of these companies are like, if you look at the financials, they don't look that bad.
Yeah.
But the stocks are just so blown out, right? And there's another element to this, which I think if you're running institutional capital, not only do you have that, like, fear of what are you doing? You just lost money on cannabis, like, obviously. But you also have a sector right now that is particularly prone to meme-like movements, right? Like, you'll just see 50% runs in a day and then moves in the other direction based on virtually nothing, like a little bit of signaling from the government.
Oh, interesting.
And so I think until that subsides, it might be untouchable for most people, right? I mean, there was, when rescheduling was given the go-ahead by the DEA. I think it was maybe in May or something. You can look at the charts of all these things.
Yeah, I saw everything ripped.
Went flying, and they retraced the entire gain, right? And nothing's really changed other than things tend to move slower than investors expect, I think. Yeah. And so all the gains were just getting back, right? So that's frustrating and somewhat uninvestable.
Yeah, that's like Will Thompson's been on this program a couple times, and he talks about mining. There's a thing called the Alessandra curve. I hope that I said it correctly. But it's basically like when there's a discovery in a mine, the stocks rips, and then it takes a while to develop. And it's like people just get bored of the time between the news and when it actually develops, and they just sell the stock. And it's kind of like it's not like a trough of disillusionment as much as it is just kind of people get bored.
I find that dynamic fascinating, lack of patience. I don't know how pervasive that has always been historically, or if that's magnified more now than it has been in the past, but I don't know if that's limited to mining. Like I see this in all kinds of things where you get excitement, and then one thing that I've been pretty heavily invested in for a while is offshore. And that sector's ripped. It's been a huge success, but there have been some comments from the companies this quarter suggesting not that there is a slowdown in day rates, but that these projects have been kind of pushed out a few months. And so you might get some weakness in the next quarter, and then at least what they're saying, when we don't know if this will actually pan out, but the guide has been that nothing's really changed. We're just kind of moving things out 3 or 4 months, and the stocks have collapsed, right? And so it's like, does that 3 months really make that much difference in the grand scheme of your IRR owning this thing? And perhaps if you have quarterly performance mandates, it makes a difference. But if you don't, presumably that's an opportunity to just hold your breath for 3 months, right? Like what really does it matter? But I do find that dynamic fascinating, and I think that's another edge for someone without those mandates, or someone running a PA, is just like simple time arbitrage. Like just waiting it out a little longer than people are willing to, because there is a lot of impatience. Cannabis is for sure the worst of those, but I mean, I think it says a lot about the people owning cannabis stocks, right?
Yeah, they should be more chill, man.
You'd think they would be.
Yeah, just let it play out, see how it goes.
Yes.
No, I mean, I hope, I don't know, I hope the cannabis market continues to develop, and I hope that the government gets out of the way, because I haven't talked about it in a while, because I didn't want to be known as like a weed podcast necessarily, but I do think, I mean, look, it's a lot better for society than a lot of the things that are allowed to exist today. So the idea that it shouldn't be allowed to exist, I think, is asinine. I'm okay with people that say none of it should exist. That's like logically, that's consistent to me.
Sure.
But once you let alcohol out of the bag, I think the idea of not letting marijuana out of the bag is silly.
I think I saw a statistic recently. I might be butchering this too, but I think it was that, and there are more people smoking cannabis daily in America now than drinking.
Oh, yeah.
And there are some slides, if you go through some of the MSO decks, like looking at the size of the market in 5 years, right? And we're looking at something it's on parallel with tobacco, and like a little bit smaller than beer, for example, right? Like there is huge demand here. If the government does get out of the way, you'll get an organic consolidation, I'm sure. And if they don't, it's kind of a win-win, because, and I'll just put it back to the Canadian environment here, but that excise tax is essentially just killing all the weekends.
Yeah, you can't be small and compete.
Right, so you're forcing consolidation. They're almost accelerating it, and that's what I really like about the setup, right, is you almost have a capital cycle that works out either way. Like either you cut the tax and these guys can start making a profit really quickly, or you don't, and there's only going to be 2 companies left. Because like, if you can look at the statistics, but like the Canadian bankruptcy filings are dominated by cannabis companies, because they simply can't survive. And I was writing about this last week, but this is purely anecdotal, but it has to be true. It must be the cheapest product in Canada for what you get. Like, it's cheaper than it was 20 years ago.
Oh, yeah.
Right? And so if you just think about what that means to the upside, right? Like if you start getting real price rationalization because the high cost guys are exiting the market pretty quickly, everyone's heading to the exits, and you start getting price tick up, and there's a lot of room for that price to run. I don't think you see any volume declines. And so these companies, I think, and they also kind of have embedded operating leverage. I think these companies can have financial profiles that people are completely asleep at the wheel on right now. And then again, if you get the loss of the government intervention with silly things like this excise tax, you might be looking at some like really large cash flow producing companies that are trading at net cash, right? I don't know. But on the downside, kind of what I find interesting and why it's asymmetric is like, I really know how you lose money with. So Kronos Group, for example, which is my largest cannabis play, is an $850 million market cap, and it has $800 million of cash, right? And they're not burning cash. And so you have a huge downside protection, even if this doesn't work out.
Yeah, unless they go out and spend the cash somehow, right? Like if management gets...
But I guess the thing that gives me confidence there is the sector valuation is so depressed that they can basically go out and buy anything. Like, you obviously take a risk of incinerating cash anytime there's cash on the balance sheet, but like...
Yeah.
But given where some of these...
Do you worry about management just paying themselves a ton? Like
Sorry?
they're like, screw it. Like, do you ever worry that the management's just like, we're not going to make... like, the stock isn't ever going to work. We're just going to pay ourselves a bunch. That'd be a whole lot. $840 million to just extract from an entity would be a whole lot.
So the history of that money is from Altria, who own 42% of the company.
So stealing from the mob.
And have half the board. And it's been a complete loss for Altria, right? Like, I think the implied valuation, I think they bought in at an $18 share price, and stock's at, $240 now? So I think they gave Kronos Group maybe $2.5 billion, and now it's down to 800 mil. But I don't think, long story short, is I don't think that there's much appetite for them to go just light the cash on fire and start paying themselves. Like, they have to do something with it by mandate, because I think but for Altria having provided that cash, like if that cash was just there organically, the thing that would make most sense to me is just a huge tender for shares, right? You're trading at cash. You have so much excess cash. Why don't you just buy back all the stock? But I just think it's earmarked for other reasons, right? And what you might start seeing, and what I hope we start seeing, is kind of start rolling up some of the smaller producers, right? And again, just accelerate the consolidation, because you do have a ton of subscale players that are still left.
Interesting. So it looks like what's going on here is they're making up their SG&A. So gross profit minus SG&A is being made up in interest income.
Exactly. They're earning so much interest on the cash balance. But I mean, so if you got the financials, you can see how long there's I don't know where you're looking at this, but there's a gross revenue line and a net revenue line, right? And
yep.
The difference between those two is the excise tax.
Yep. 33 million on 120.
That's a huge chunk of money, right? So
yeah,
if you look at Organigram, OGI, which is, I think, the closest company you'll find to Kronos Group, they actually produced a GAAP profit last quarter, and you have, I think, something that would be close to a 50% EBITDA margin if you got rid of that tax.
Okay.
So I think ahead, and I just say, is this tax sustainable, right? Because yes, it generates a fair bit of revenue for the government, but at a certain point, if you keep it going, you're just going to kill the entire industry and lose that tax revenue. So it doesn't seem to me like that can be sustainable. Maybe it goes for a few more years, but at some point, you're just going to kill the revenue at the source, i.e. extinguish the entire industry. And so the government, even if they don't do us a favor, are going to have to just do that out of, purely selfish reasons at some point. And if you own a company like Cronus or Organogram, who can survive for years with their current cash balances, you're kind of just waiting that out, right? Like, there's no...
Assuming interest rates continue. But to your point, even if interest income was off the balance sheet or off the income statement, you still have 10 years, call it 8 years of runway on Cronus.
And just, to go back to the pricing thing, right? Like, prices are all-time depressed, right? Like, this is like a commodity. Like, you think like an oil company sell a barrel at like 40, right? And still kind of eking out a profit, like not losing money at least, right? And so and things can always go lower, but it is absolutely ridiculous, the price of cannabis, right? Like you can get like poor quality ounces of weed at a dispensary in Canada for like $50-$60, right? So we're talking
for an ounce. Yeah, that's a whole lot.
Quantities that can punch people for a couple months, right? Like that's not sustainable, and they're still doing okay. So I just see a ton of levers to pull on the upside, and then the worst case scenario is maybe they start burning cash and like it doesn't work out, but they trade at cash, and so the downside is minimized, right? Like I've learned to be extra careful with the idea that you have as strong of a margin of safety as you think you do sometimes. But in a context like this, I mean, this is not the kind of thing where you're going to lose half your money buying at these valuations. Vision, right? So, whereas the upside could be multiples.
Yeah, well, and I guess in theory, even if you can lose half your money, if the upside really can be multiples, you can, if it's position sized and you have confidence, then it can work, right?
Exactly.
I don't have a good answer for why I haven't followed along for it going on recently.
Yeah, but I mean, it might just be that, you're not alone in not following it, right? Like almost no one is.
Yeah. Although
people roll their eyes. I pitch this, right? Like they actually just roll their eyes, and like,
I would not roll my eyes. That I know is foolish, but I don't know. It's weird. Like I said, I got to the point where I was like, why isn't this sold in C-stores? Why is the retail? I guess maybe part of my problem is I'm looking at it from a too U.S.-centric and maybe even East Coast-centric problem. I mean, maybe the people out West have a much better feel.
Yeah. The U.S. landscape is more complicated at the time.
Yeah,
right?
You got a whole lot of states that really need to rely on the revenue. Florida's still trying to keep it be like prescription-based, and then, I don't know. I've had my license lapse twice, and the last time I did it, I was like, I don't even know if I want to go like mess around with the doctor anymore. Like, doctor's a quack. They're going to charge me $200. I don't know. It's almost not worth it.
Sure.
It's annoying. I have to like look at this person and try to take them seriously, and I'm like, you're an idiot.
Right.
Sorry if you're listening.
As the demographics of the country, as the millennials get older and Gen Z gets older, it's hard to envision there not being an appetite for this legal at a national scale. Maybe I'm wrong about that assessment, but I can't see such a convoluted regulatory landscape persisting for that much longer.
Yeah, I agree with that.
You either just legalize it or you don't. But like the way it's operating right now is completely insane, right? Like you can't navigate the infrastructure of this. It's terrible for the companies. It's terrible for investors. Capital markets largely closed to these companies, right? Like it doesn't need to be this way. And I think that there is more than sufficient political will to get rid of these barriers. Yeah, I don't know. It's interesting because, and not to talk politics, right? But like it's not really a favorable environment for either party, because you have, on one hand, Democrats kind of being increasingly focused on regulation and the administrative state. And then for the Republican side, it's just kind of like a sin, right? There's still that evangelical taint, or evangelical wing of the Republican Party, which is really not interesting. I mean, as you see what's happening in Florida, which is not even really evangelical, right? But you have kind of both sides that make this way complicated than it needs to be. but hopefully one day.
Yeah.
But it's kind of why I play the Canadian ones, right? It's another reason for it, which is that it's already legal in Canada, and there's no way we're going back on that up here.
Is that why you guys can't build enough housing? Everybody's always stoned.
Yeah, everyone's just moving too slowly.
Yeah, they're like, come on, man, I don't want to build. So when you're messing around, and I shouldn't say it that way. I shouldn't say messing around. When you are researching these smaller cap companies, how do you get around the public company costs that is necessarily associated with being smaller? And how do you think about some of the incentives in some of these smaller names?
Yeah, it's a good question, and it really depends. Sometimes you do see, sometimes the lack of scale can make it interesting for more of like an event-driven setup where you think, hey, this thing is going to get taken out, right? Like if you have a company where there's a real product there and it's pretty good and the underlying economics look attractive, but then you have this bloated like corporate SG&A expense, which is kind of, well, it's not even bloated, but it looks bloated because it's so large in relation to the rest of the company. That might kind of be a signal actually where you're like, hey, maybe this is going to get taken private. And I've had that happen before, and I do own a couple names right now where like I think that's kind of the base case of how it plays out, because it's interesting when you go really small, you do see a lot of companies where you wonder, how did this even end up public, right? Like, why are you public?
Yeah.
There's always some kind of interesting story there, right? Maybe it's just a fall from grace and it's now tiny.
Yep.
Or a lot of like kind of SPAC boom dynamics, stuff like that, where you're like, how the hell? Or sometimes it's like really, really old companies that went public for whatever reason. It's not even that easy to ascertain, right? And that can create an interesting way of looking at things where you do kind of look at the incentives and you say, why are you here? And sometimes it's a problem, right? Sometimes it is just someone paying themselves an egregious salary, and there's nothing you can really do about it because they have control of the company. Like that does happen sometimes. But then you just pass. Then there are these opportunities, I mean, to talk about things that have fallen from grace, right? Like my largest position right now, and it's really turned into a big winner, is this Canadian company called Cipher Pharmaceuticals. And if you look at the stock chart on that, it went like, I think it fell like 90%. And it's actually it's starting to come all the way back up. You just see this U-shaped chart, and basically what happened was a series of poor acquisitions and a patent cliff for one of its products, and then you had the founder's son step in as CEO kind of at the bottom, and he's completely turned the company around. And so there you had a setup where this is a tiny company, but only because of a bunch of things that have gone wrong here, and it's actually rather good business. And so you're starting to see it now. Like I think it's maybe the market cap's 300 mil or so. It's just getting bigger. And those concerns about like public company costs start to get assuaged, obviously the larger the market cap gets. And so sometimes you do just see like this is only a micro cap because it's fallen from being a larger company and we can get back there. And therefore you're willing to kind of just it's not a deal breaker that they're burning some cash on corporate costs, right? In other situations, it makes absolutely no sense. But you can get, sometimes the economics, like the unit economics, are just good enough to justify those expenses, right? Like that happens too sometimes. But
how do you find Cipher?
How did I find it? I actually found it. There was a write-up on the Value Investors Club on it. I think it was pitched in like the $2 range, right? But what happened there was the stories. It's been it's a worthwhile kind of case study because the setup has continued to kind of morph into something new, and each step along the way has offered basically say at $16 today, I don't think it's that much more expensive than it was at $3. Like things had just kept improving, right? And so when it was initially pitched on Vic, it was sort of this really low multiple asset light, like kind of like a coupon, like a bond coupon yielder, which just sold like a legacy pharma product, and it had a ton of cash on the balance sheet. And it was like, hey, you can get like a pretty nice free cash flow yield on this, and you get a free call option on this drug that they have in the pipeline. So then that's kind of when I started looking at it. And then the stock goes from like 2 to 5. And then they filed a prospectus for a substantial issuer bid, which is basically a tender in Canada, like a large buyback. And you have to file accompanying that is like attached a valuation report. And so I'm looking through this prospectus on the buyback, which in and of itself is pretty interesting because they have too much cash and they're cheap. But you go into the valuation report and there are these projections for the company's operating income based on the pipeline asset getting approved. And you can see it goes from like, I want to say 10 billion of operating income to like 35 in the course of a few years. And so you're looking at this and saying, well, the stock at $5 is at like 2 times operating profit in a few years, if they're right about this.
Yep.
Now, in the microcap space, how many people read that prospectus? Like very few, surely. Like I'd be shocked if more than a couple hundred people read that. That's probably even too high. Like at the time, right?
Yeah.
And so then it kind of leads to, well, what is this pipeline product and is it going to get approved? And I'm certainly not a biotech expert, but in this case, it turns out that this product is already approved in 13 European countries, right? And so that lends a ton of credibility. And one thing leads to the other. And I mean, it still doesn't have North American approval, but it turns out that doesn't really even matter probably because of all the groundwork that's been laid in Europe. And so that kind of starts picking up, starting to become more popular online. That starts getting traction. Stock goes from like 5 to 8. And then last month, they took that massive pile of cash that they've been building up on the balance sheet and they bought an asset which doubles their operating profit and really transforms the business strategically in many ways, but kind of the most predominant way is it turns it into a growth stock because this asset they bought has a ton of upside growth potential. And so we've gone from this like basically no growth cash shell with one product that just kind of spits out a nice coupon to
a growthy asset.
Something that's probably going to grow at like 35% a year for the next several years. And so it deserves that higher multiple it has now, but it's also like not only have you had very big multiple expansion, but you've had the earnings number grow a ton, right? Like it's, I think conservatively, even now, we're looking at like 5 times growth in operating income by 2027. And so it's a worthwhile story to, I think, review because it kind of shows you what can happen when, well, A, you have a really good manager at the helm in a microcap, right? Like a CEO owns 40% of the company, came back incentivized to turn this thing around. So it's really good capital allocation, like very timely buybacks. So again, I kind of see the importance of that. You can see the importance of an asset-light company that doesn't need capital to run its current business, right? Because what you've had here is so much cash flow generation, which has enabled this transition, right? Like this company is so asset-light that there is no cash flow from investing section on the cash flow statement, right? Like there's zero capex and very little working capital requirements. And so basically you have this cash generative legacy product. And then what are you going to do with that cash? If you buy that at a low multiple and you get good capital allocation, you might get a situation like this, right? Like obviously it's not going to happen that often where something goes parabolic like that. But if you spend enough time looking at microcaps, you will find that that's not an outlier. Like there are examples of that happening with pretty decent regularity. So I think if you develop some good pattern recognition there, and I think really importantly, have the discipline to say no to almost everything, there's definitely opportunities like that for real outsized returns, right? And it's not something that's on offer as much as you move up in market caps, obviously.
Yeah. I don't know when I was on Value After Hours, but I said something like small and expensive might work well. And I was thinking about some of these med tech companies that have gotten like that whole sector, and not just med tech. I mean, I realize Cypher is pharmaceuticals, but I kind of understand why small caps are naturally a place where that type of business would go.
Yeah.
Especially if they have R&D components, right? Because they do kind of need access to capital markets to continue to spend. And I can totally see why, going back to our conversation about investors get really tired. I mean, follow-on offering after follow-on offering, can get really tedious.
Yeah. Sure.
And then sometimes something can hit. Or the time they put in since 1998 finally has the technology of today.
Right.
And it's actually becoming the vision that is the reason the company went public, right? And you got to sift through a lot of trash to find some gold. But I don't know any situation in life where that's not true.
That's exactly right. And I think actually that point about sometimes the technology takes a long time is super applicable, and even more so just like the function that this business is attempting to fulfill might just be really delayed, right? And there's another one which is, I think, earlier. It's actually, I mean, if you look at it, I think it's a 10x in the last 5 years, but I just got involved kind of recently, and I think there's a lot of upside in it. Has some similarities to Cypher, which is a company called BQE Water. And what they do is water treatment for mines. So basically, you have a regulatory landscape that has become increasingly stringent.
Yeah. I would think water and mining runoff, I would think would be highly, highly regulated.
Pretty much every mine you're going to come across has some kind of water runoff concern, right? And huge amount of regulation. So this is one of these companies where the service is mandated by regulation. There's nothing you can do about it. And
historically not a bad place to play.
Yeah. And the miners are not cost sensitive because they have to do a small fraction of what they're paying for at the mine, right? Like they just want it in their filings with the regulators, right? So they can get the mine approved. But
is this one of these scenarios where BQE has demonstrated that there is a good enough what's the word I'm trying to think of? Steward of the water, that like once they're proven that they can do it at this mine, all of a sudden the next mine just says, well, we're just going to use BQE because like why mess around with anybody else?
I think we're getting there, right? Like it's still early, but for example, they've worked with Glencore for 20 years.
That's not a small firm.
No. And what's interesting about this business is that every mine is unique. Right, like you're kind of building an ad hoc solution for water treatment at every mine that exists because the kind of contamination could be selenium, it could be something else, will require its own method of treatment. And so what they've done and then this is kind of getting back to what started me on this, which is the transformation of the company, right? So you've had on one part of that is just these guys have existed for a long time, but it's only now that these regulations have become so extreme that like they become more integral in the mining process. Two, you have kind of the cyclicality of mining back on the upswing. But three, what makes it super attractive is that they have changed the operating model in a way that makes it far more attractive. And so what they do now is they come in and they provide what is essentially consulting services to the miners during like the permitting and development stage of the mine. Which they just charge a consulting fee for. And then once the mine is ready to go, the miner actually pays the capex to build out the water treatment facility. And BQE charges what is essentially a toll on the volume of water treated. And that could be for 20 years because it generally by regulation is just going to have to run for the life of the mine. And in some circumstances, even after the mine shuts because there's continued runoff. And so what you actually have is an asset light kind of toll booth and a lot of white space because obviously there's a lot of mining development and this is a tiny company. Like they don't need to penetrate more than 1% of this market to be a multi-bagger, but they are kind of at the leading edge of certain technological aspects of this, particularly selenium treatment, which has become a particularly pressing concern due to some environmental disasters in the last 20 years. And so you basically have these guys coming in, investing nothing in the project, and then just clipping recurring revenue potentially for years, right? So you kind of, again, get that like quasi bond coupon structure, super asset light, very high margin, which then frees up all the capital for shareholder returns in one day, right? Like that's kind of that's the hope.
It's wild. The gross profit in this thing went nowhere forever, and then started to go somewhere.
Right, because what they were doing before this is actually, first of all,
this is tiny. For anyone listening, this is very tiny.
Very
really do your own work. This is high octane stuff.
Yeah,
illiquid, $7 million in gross profit.
Yeah,
but it was like 1.5 million for, I don't know, from 2013 or I don't know, maybe even 2008.
Well, and they have a project that I believe is going to be coming online soon, which could just double the recurring revenue. Like what's happened is the way that they've charged for the services is that their largest project a few years back before this transition was a joint venture in China where they did water treatment, but how they got paid for that, and this is still on the books and it's still a small part of the business, but they'd actually get paid because when you treat the water, you extract the minerals that have been caught in it, right? And so you would
tell me they sold the minerals.
They sold the copper.
That's a bad business.
Terrible business. It was a very bad business. They're actually carrying the facilities on their balance sheet, paying the cost to build them out, and then getting paid with commodity pricing, right? So it led to a complete disaster. They brought a new CEO in about 10 years ago who I think is sort of the one who came up with this model for the industry, and it seems to benefit both the miners and the service providers. Well, if you think of this more as a service provider now than like what before was a provider of inventory, right? Like they kind of like they built these plants for the mines. And so it's been a radical transformation. And it's one of these things where, yeah, you're right. It's tiny, it's illiquid, but the runway is very big. And given the nature of the model, that growth can be captured without really any capital reinvestment. And so you're not relying on your balance sheet to capture the market. And so this is a kind of setup where I think you could see something really turn into a larger company if they execute well.
Interesting. It's funny. It's not every day that I see a shareholder list that looks like it's all people.
Yeah. The three largest shareholders are all individual people.
Yeah. And although the 240,000 shares is at $65 a share Canadian is not nothing.
Well, yeah, I mean, and this is again what makes it it's like a quasi-private investment, right? Because there are 1.3 million shares outstanding, and more than half of those are controlled by those three shareholders, and then the CEO and a couple board members. So really, you've got to float somewhere in the neighborhood of 600,000 shares at $6 Canadian. That's not a lot of stock, right? Like
no.
So, but
is that part of why it's tripled? Do you think?
Well, I think it's tripled because the earnings power is kind of starting to manifest itself here, right? Like you've hit that inflection, which is not unique to microcaps, but where you do have the recurring revenue part of the business now take over from what was previously that joint venture copper part of the business. And so you're starting to get higher quality earnings. You've had the kind of legacy code declining and the new model increasing. And so people are starting to put a higher multiple on it because the way that they have laid out their projections, which I think is definitely feasible, you can sort of see like they did 4.5 million of EBITDA last year. They might be tacking on $1 million or $2 million every year, just based on getting 1 or 2 new projects, which is not a Herculean feat by any means. So you have a really easy way to 50 to 100% growth in recurring revenue for several more years here. So, I mean, if you look at the multiple, it doesn't seem cheap for a small business like this.
No.
But if you look ahead,
20 times EBITDA or so.
yeah, but it's growing at 100% a year, right?
Yeah.
So
That old EBITDA to growth, right?
yeah,
Yeah.
and they have these what they call company maker projects, which they haven't really disclosed much of the details on, but if you're willing to do scuttlebutt, you can kind of figure it out. And so I've written about one of them on my blog, but it's obvious that this is their project because the mining company has to file a document, and it's a Canadian mine. They have to file a document with regulators explaining how they're going to treat the water, and you can see BU's name all over it. But what you can also see is what the miner expects to pay for the water treatment services. So you can sort of like backdoor that into what they're going to generate from this project, which is clearly going online. It appears to me that I think they're doing $8 million of recurring revenue today, company-wide. I think this project will contribute a further $8 million of recurring revenue. Right? So that doubles the recurring revenue, and it's 50+% margins with some operating leverage, right? Because you've got fixed cost G&A. It's really just a gross margin.
Yeah. Interesting. How the hell do you come across this thing?
Honestly, this one, somebody dropped into my DMs on Twitter and said, you might want to take a look at this.
It's better than some X-rated thing. I'd rather have people drop good ideas in.
Yeah. Well, I think I tweeted something to the effect of, like, what's a Canadian microcap that could become the next Cipher Pharmaceuticals or something? And somebody messaged me, and I looked at it, and it didn't hit at all at first. I was like, I don't understand this. Like, 3 segments, like this copper business looks terrible. It just didn't click for whatever reason. Then I got asked to pitch a stock on like a Twitter Spaces forum.
And you were on that.
Yeah, and it was
the microcap forum, right?
Yeah. Well, I think there's been a few of them, but I was on one, and it's very, very microcap focused. And it was like, okay, well, knowing the audience, like some of the things that I own aren't going to work here. So I kind of started like thinking about it, and then that got me looking at this. And upon closer examine, like the stock was at 40 at the time, and upon closer examination, I was like, this actually looks super interesting. So I did a write-up, and I pitched it on the Spaces. But before that, I mean, there was very, very little attention on it. There still is, and like, it remains to be seen if this one's going to work out as well. But I mean, it's worked out very well for the guys who bought it 5 years ago. I don't know how you would have discovered it at that point or even gone liquidity. Like, I think that was a private placement raise. Like, if you wanted to buy stock back then, yeah, it's up, what? Looking at the chart here, 5 years, it's up 800%. So those legacy shareholders you're seeing in there, I think, have done super well. But yeah, I mean, it's a big position for me, and it was kind of probably the idea that I've been most associated with, like, since I like launched the public persona.
Oh, interesting.
Yeah.
I think of you for Howard Hughes.
Well, it's one of my favorites.
Because I was like, I don't know, you're just hammering it. And I was like, this dude makes a lot of sense. And then I got a buddy that owns it that I've known for a while. He bought it. I think he bought it from the General Growth. So it was like,
wow. It's
yeah, he's owned it for a long time.
It looks like Ackman might try to take it away from us here, but
yeah. Well, we'll see.
Yeah.
That was kind of always the risk, it seemed.
Well, I mean, yeah, it's hard to complain if you got a big enough premium, but I'm skeptical.
Yeah, I don't think that people that are going to be selling are going to be totally thrilled. It's not a counterparty that I think people get like screaming deals from. I'm not even saying anything like negative about the guy. He owes his clients a fiduciary duty.
He's a shrewd guy. I mean, I don't blame him, but it's unfortunate timing because it looks like the business is about to really inflect. Of course, right?
The part of the Seaport spin, and Bill Chen may have put this in my head, but that I didn't understand is I understand wanting to separate the entertainment assets and like sort of the housing and the office assets. The minor league team, I think, should have stayed with Howard Hughes because I think it's like part of the community.
Yeah.
Right. I don't know that you want a separate public entity trying to raise ticket prices on minor league games for your community.
Yeah, it's interesting. My view of I own a good amount of Seaport as well. I think it's pretty interesting. And I have sort of thought that the baseball assets went with Seaport for two reasons. One is that it's not really it's not an MPC, and I think they're really trying to just be like, we are a clean real estate development kind of MPC company. But I also think it doesn't fit with Seaport either. And it's possible that might be an asset that they try to shop pretty quickly because you have a lot of funding needs for some of the Seaport assets, like the actual New York Seaport assets, and they're burning a ton of cash. But the breakup value, I don't know how closely you looked at Seaport spin, but I think the breakup value is pretty clearly $100 a share versus 25. But nobody believes in the story, right? And you've got Ackman with the potential to take up to 70% of the company on the rights off, right? If no one subscribes, and it's cash burning. But in kind of going full circle to how we started this, that is a hated collection of assets, right? If you want to look somewhere where people have kind of lost the ability to think straight, I think that's a pretty good place to look. Not saying that.
Why do you think they've lost the ability to think straight? It's always been on the come, hasn't it? It's just been problem after problem.
It's such a disaster for Howard Hughes, right?
Yeah.
I think they sunk $1 billion into it, but they took a $700 million impairment last year.
Ugh. Yeah, that's not great.
And it was advertised as being their crown jewel, and I think a lot of vanity went into it, right? You had kind of just let's buy this slug of Manhattan and put some luxury restaurants in there. And I clearly spent way too much money on it. It never worked. And Howard Hughes itself, as a result of this, and due to some other issues, is also really hated. So it's interesting to get a dynamic where the parent company of the spin is already something that people probably don't like thinking about very much. It's not a particularly popular stock. And then you have just spinning out the piece of that's hated even more. But the way I kind of look at it is it's a piece of Manhattan. It must be worth something.
Yes, unless it's completely misused and you got to tear it down and rebuild it. But I mean,
yeah, and then everyone has their theories, and playing the game theory with Bill Ackman doesn't really get you anywhere. But I do kind of. First of all, why is he willing to spend $175 million to backstop this thing and have his LPs, presumably it's within the Pershing structure? So you're going to own this micro cap in a much larger fund. Doesn't fit the mandate at all. But then the thing that makes it even stranger from an incentives perspective is to flush Seaport out, put yourself in a situation where you might have to end up owning most of it anyways through a backstop, and then putting a bid in on Howard Hughes, right? You might just end up in a situation where Ackman owns both these assets again, separated. So I've spent a lot of time trying to figure out what his incentives are here. I'm not sure if I've heard so many different ideas, and it's possible he just got frustrated with the Pershing US debacle and then has just pivoted back to wanting to buy Howard Hughes. There's a ton of interesting theories out there. I don't think anyone knows, but it is kind of odd to spend all this money on a spin-off, right? A Howard Hughes, I think, spent $30 million kind of getting the whole thing spun out, to then have Ackman buy both the companies separately.
Yeah, that would be a little odd.
It's a little odd, right? But I don't think anyone knows what he's thinking. I like both the assets, and
my guess is he's thinking he's going to make money. That's my guess. But I don't know how.
But when you see that, the breakup value of the Seaport assets is probably $1 billion, and you can buy it for it's incredibly cheap here because pro forma this rights offering, they're doing the enterprise value is $230 million, at $25, and then there's a bunch of data on that which is not recourse and you could probably exclude for your calculus, and at which point you have like a enterprise value that's like in the 100 millions. And the baseball asset, like the baseball stadium itself, cost 130 million to build 5 years ago.
Gotta assume you want to replace it.
Sure. Yeah, I mean,
like it could just be a complete misallocation of capital.
Haircut that in half, right? Like call it $7 million. That's still a good chunk of the enterprise value. And like a non-core asset, you get all these buildings in Manhattan. I know that they're cash burning. Like there's a lot of hair on it. But my kind of Occam's razor for Ackman's incentives here is that he thinks that it's worth a lot more.
Yeah, I mean, look, I think people can have opinions of Ackman. A lot of them can be driven by how he uses Twitter or whatever. But I don't think that I don't think it's valid to think he's not in it to make money. His track record would suggest he is.
I agree. But people, and like, I don't necessarily subscribe to this view.
Whether or not you get taken under is sort of a different issue.
That's the
You're not on the same side of the table necessarily.
But he has to buy, per the rights offering backstop, what could be a majority of the company at $25 a share, right? And it's basically at 25 right now. I think it's gone surging today, but it's in and around that range. And so it's not like the take under thing. Maybe he can grab an extra 30% of this for a really low ball price, but he's already having to pay what we're paying at 25, right? So I feel like he just thinks this is really cheap and something could happen here. And if it goes up 4x, he's got a $1 billion market cap in Pershing, which makes a lot more sense. But I don't know. It's hard. I think because of the distrust that a lot of investors have for him, they're distorting the incentives. But I could be wrong too. Maybe he is up to something, but I just think he probably thinks it's cheap, right? I don't know.
He's been doing a lot of things, whether or not it's the Spark and PSTH and
whatever you think about him, I think you can't not give him credit for always trying new things, right? Like he's a very resilient guy, seemingly.
Yeah, and he seems quite talented at real estate. So
yeah, absolutely. I mean, yeah, he's got his big failures, but he never stops trying. So I don't know what he's gonna do with these two companies, but I do think it's both Howard Hughes and Seaport are really interesting entities to look at, whether from an investment perspective or just like trying to
curiosity.
Yeah, it's a very curious case of very kind of N of one situation. I mean, see where those go. I have no idea, but I do think at current prices, they're pretty interesting.
The thing that still confuses me about like the REIT series, I mean, it doesn't confuse me, but I guess the question I cannot answer is it would have been nice to see if rates had continued to go up, would the stocks have worked? Because, the question that I said to Bill the last time he was on is it really just a rates trade? And I think these sort of fall into that same question, right? Is it rates or is it really cheap? And
yeah,
maybe the answer doesn't have to be one or the other. Maybe they can occur at the same time.
I think that it's both. And what I mean by that is I don't know if the stock works if rates were to go up, but like, does the business work? And will the market eventually just like give it its worth? I think are different questions, right? Like, I always found the Howard Hughes in the last couple of years, like trading on rates to be a little bit ridiculous. Like, obviously that's impacting the cap rates, but like you have like what is a pretty like decent capital stack. And a company that's just like, yeah, rates are higher. It puts pressure on cap rates, but also NOI is growing a lot, right? And so those two things are fighting against each other. But I do think that like there is just this general flow of funds going in and out of these names based on the anticipation of where rates head, which, again, kind of like the cannabis thing, I think sort of makes people pass, right? Like if you have a quarterly mandate, well, it's like there's nothing I can do about these like flow of funds based on like some weird rate expectation. It has nothing to do with the company really, but maybe it's better just to avoid this because it could just get money. And that's what happened. I mean, it was when I first started tweeting about Howard Hughes, it was in April, and I think it had dropped below 60. And I was a company that I'd watched for a long time, and I just kind of thought, like, this doesn't make a ton of sense. But it was at a point where people were pretty preoccupied about the direction of interest rates, right? And so it created an opportunity. But I think you're right to say that, like, if rates just kept going up, this probably wouldn't work.
Yeah, and look, I mean, 6 months is not working or not working, all right? And that's only been 4 months, so that's like short-term stuff. But I agree with you.
From a private market owner's perspective, I don't think the rates really matter that much. But from public ownership perspective, it is kind of the thesis, which is a frustrating thing sometimes about public equities, right? Is they may just not trade on fundamentals.
Well, Ian Castle said something about smaller names that I thought was pretty sharp. He said a lot of people don't like to own them because if you go into, like, let's say it's the 30th of some quarter end and somebody just decides to puke it, like, you're kind of screwed.
Yeah.
For the quarter.
Yeah, exactly.
Right? Or, I mean, if you have monthly marks or whatever. So you really need to have, like, that intestinal fortitude to just not care.
You often have some kind of alignment with your LPs, right? And perhaps some kind of compensation structure that's not based on that, because it does make it difficult, right? Like, if you have someone just decide they need out and the stock drops 20%, that can ruin your compensation for the year, right? Depending on how your fund is structured. So, I get that. But at the same time, that volatility can hugely be your friend. And I think if you keep at it and stay disciplined, then perhaps over longer periods of time, it can actually help your returns.
Yeah.
Like, if you follow in a stock flow stance, like, oh, this is actually BQE, the one I was talking about, it dumped a couple months ago. There was a director who'd been, it's not really like a core person in the business, but was starting to exit. And it put a lot of pressure on the stock.
Who the hell are they selling to? Like, no one, right?
No one, right? So I was buying them. But, like, you did have, and then they released earnings, Q1 earnings, which were, like, fine. But then this is something you also get with these microcaps is sometimes the investor base might be a lot of retail people who saw me tweet about it or something and don't fully grasp the idea maybe.
Yeah.
And so they see Q1 results and they see revenue down and they start dumping without realizing that Q1 is a seasonally weak quarter and therefore, like, it's not surprising that it's down, right? Or that there are just kind of, like, maybe the cadence of revenue is just a little bit different than a quarterly thing, which I think is what's going on. But anyways, the stock went from, like, 67 to 53 and then back up to, like, 62 within the day, right? And so you could have been a buyer at 53, been up double-digit % on the basis of nothing other than... Although, as I'm saying this, I'm thinking about what happens to mega cap tech during earnings. And it's not any different, right? Like, sometimes you'll just see, like, Amazon's down 7% and then after the call, it's up 5%.
Yeah.
I'm not really sure that's much difference there, to be honest. Like,
well, the microcap stuff is a little different. I mean, I'm watching one right now and it just won't go down. And it's like the probability that the incremental money, I mean, I don't know. I may know most of the people that are buying it, but it seems like it's probably new people. And the idea that they're going to be there for the long term, I think we'll see.
Right.
It's up to them to do their own work.
Yeah.
Know what they own.
Yeah. I think if you think about these things as quasi-private investments and maybe you have them in a PA, look at it that often and you, like, kind of get to know the operators and believe in the business, you can sort of mitigate the psychological costs of some of that illiquidity.
I said that to Sweeney. I was like, it's almost as if you're paid not to look at these things.
Yeah, exactly. And you obviously, it magnifies the importance of doing work, right? Like, you really need to understand this business and what you're doing here, because you're paying a premium, like an illiquidity premium, on the way in and then a discount on the way out. And it's just like a high implied cost of equity, right? Like you're just kind of, and I mean that also psychologically. So it's not the kind of thing that you should, I mean, you really can't do it, but it's not meant for trading.
Yeah,
And
that's right. I like that.
I don't do that anyways, so it's fine with me. But it really does, like, I can't stress it enough when I talk to people about it. Like, you really need to, like, be comfortable with what this business is doing, because if they have a bad quarter or something, you're getting out for really low, right?
Yeah, everybody else is getting out, and then if you want to get out, you're probably moving it lower as you get out. So have fun with that.
Exactly. Like you almost kind of think about it like, once I put this money in, I'm not getting it out. I'm in this business. It's like investing in a private vehicle. Like we have a 5-year exit strategy or something, and like who knows what the mark is.
Yeah.
Right.
Yeah, I think that's the right way to go about it.
Yeah.
And if nothing else, it puts you in the right frame of mind.
For sure. I think it's advantageous frame of mind for public market investing broadly.
Yeah.
Right? Just kind of thinking about things like you're an owner in a private business and not getting too bogged down in the minutia of like daily and quarterly movements and focusing more on what the business is doing. Now, of course, the issue with that is that if no one else is thinking about markets that way, you might not get the value you think you're going to get, right? Which is...
Yes, but if you trust management and you believe that it's going to be cash generative, you haven't heard the episode yet because it drops tomorrow. But one of the things that Richard Cook was saying is, like, he's invested with people that understand buybacks on average. And, like, eventually you will get that money out. That can be a real bag holder thing to say. And I understand why, like, short-term people would laugh at it. But I think it's closer to reality.
Yeah.
What I don't know that I believe anymore is that I have the ability and or willingness to take like these concentrated bets for a number of reasons, which is not to say that people should or should not. Everybody has their own goals. But for me, I've kind of been like, all right, I could be wrong on the people. I could be a little bit more wrong on the business than I thought. Like my risk tolerance has gone down.
When you say concentrated, what do you mean by that? Like 5% positions, 10%, or?
Oh yeah. I mean, I would say, look, I'm not going to ever run like a 6-stock portfolio. That's just a function of what I'm trying to accomplish and where I'm at.
I don't think many people can handle it.
Yeah. So, I don't know, like I'd like to hover around 15 to 20.
And I think for some people that's concentrated. Like I think some people, right? I mean, particularly if you allow, which is kind of the way that I approach it. I think I own a little bit more companies than I would like to. Actually, I know that I do, but the problem has been just, I think, a really interesting opportunity set recently. But if you have 15 stocks, right, and then you kind of allow for them to run, you kind of end up getting some kind of organic concentration.
Yeah.
Right? Where it's like, for me now, Cypher Pharmaceuticals is almost a 20% position.
Oh my.
But it's certainly to start there, right? It's just I didn't sell any of it. But now it's like I feel concentrated, but I do own like 15 stocks.
Yeah.
But because one of them is it's just gotten so bloated. I mean, maybe that's one way of approaching it, but then you just now have the same problem where it's like I have a lot of money in one company, even though, but the other one's just become insignificant, almost.
Yeah.
Which sort of like reminds me of that thing Buffett had in his letter a couple of years ago about whatever the 10 or 12 decisions that Berkshire's made that have like made all the difference, right? And that you can kind of see that in portfolios. If you don't have too much turnover, what you kind of, I think, pretty quickly realize is you can actually afford to make quite a few mistakes if you have a decent slugging percentage on a couple of the ideas, because the stinkers will just like fade into nothing and winners will come to dominate your portfolio, right? Which I think,
Yeah, you just can't swing like super hard and strike out.
No, I agree. That's why I tend to kind of, I size them not, I don't think I've ever taken more than a 10% position on sizing.
Yeah.
But then if that stock doubles and you still like it, maybe, I don't know. I think it's slightly, not even sure that makes sense rationally speaking, but psychologically it feels different, right? It feels like a different kind of concentration.
Yes, it's funny because some of the things that I say, like, I wonder how it sounds, or I think like, oh, well, somebody that's a pro at like 0.72 would clearly think this is stupid or whatever. But there's just a lot of value. Like when Berkowitz said the cash is financial value. I mean, I would argue there's a level of diversification that's financial value too.
Yeah.
And the ability to just be like, this isn't going to kill me. I can take my time to figure out what I actually think, and to not have like the monkey brain or lizard brain or whatever of like, I'm being attacked, I need to figure out something right now, goes a long way. And you know, hopefully on the concentrated stuff, you have a sense of what you're looking for before it, so when it happens, you can be done quick.
Right. Yeah, I think that's why I say psychologically it's different. I think if you had, and this could actually be a totally foolish thing, obviously, and it could be a sense of like survivorship bias, but I think when something's worked for you and you've had time to really start to understand the business and trust the people running it, perhaps there's a sense of comfort in that, even though it's become large. And of course that can be a trap, right? Because you might just be early and end up being wrong later on. But I just, for whatever reason, feel the longer I own stock, the more I'm kind of involved with the company, the more I feel comfortable holding it in larger size. When I initiate a position, I'm generally like, I don't know, I'm more skeptical about the work I put in.
Yeah, as you probably should be, right? You don't know what you don't know. Maybe. I mean, I said it the other day, like, I wish I could learn from other people's mistakes. I wish I could learn as well as I otherwise would learn without money on the line. Like, I just don't.
Yeah.
So the dumbest possible thing is to be like, it doesn't matter. I can still go big in the beginning. But, you know, it's, I don't know.
Yeah, it's
the more I do it, the more I realize there's a lot of art to this.
It is such a craft, right? Like there's a lot of ways of doing it, but the contradiction I was talking about at the outset of this kind of also applies to the idea of concentration versus diversification, right? Like, as you imagine you find something like I did with Cypher Pharmaceuticals when it's $3 and you just go all in, right? And you're done for your career. Right?
Yeah.
The problem is like you're gonna zero yourself if you're wrong, right? But
yeah,
you could long run save yourself so much brain damage and psychological torment by just finding a big winner early on in life that you concentrated on and letting that ride, right? And then there's the calculus of like, well, do you have dependence? Are you really young? How much money is really at stake? I do think these variables are always changing throughout time, right? But there's something to be said about taking those swings early on in life, I think, or at least when you can afford to lose that capital. It's sort of like, sure. It's like the poker analogies, right? Like you never want to go all in, and you always want chips on the table. But when the odds are stacked in your favor, I think it makes a ton of sense to swing. But, you know, that calculus is impacted so much by your circumstances in life, right? Like I don't have dependence up in my early 30s. So I have, I think, more of a stomach for this kind of stuff, right? Than someone who has 5 kids and, you know, has worked their whole life to build this savings.
Yeah, that's right. Just make sure your LPs understand that and don't over allocate. I got myself in a problem once where I over allocated to somebody.
Yeah.
I still am mad about how it all went down, but I blame myself more now than I used to. I still think it's like 70-30 on them, but the 30 was on me.
Yeah, I think, it's part of what I said, I think, before we started recording, which is just the portfolio management aspect of it just has to change regardless. It doesn't matter like how big the fund is or the instructions you give the LPs or like what the purported understanding is. Like, I just think like there's a kind of required respect for this kind of thing where it just like, even if you tell them like this is going to be really concentrated and the volatility is going to be pretty wild, I think a lot of people can sign off on that in the abstract, but then when it happens, they can't, right? And
Facts. Big
you
facts.
you just have to be cognizant of that. Like, yeah, it's fine. Like, I don't mind being down 20% of the day. It's like, I can guarantee you will really mind. Right.
I'll tell you when you mind is if the market's only down 10,
Yeah.
or if there's a prolonged period where the market's up. Because a lot of these stocks, at least from people that I'm learning from, there's one that, I'm involved in, and it's kind of in the Lasanda curve part, right? And people are really getting frustrated. And a number of people have been like, look, some of my biggest winners went nowhere for 3 years, and then they popped, right? And it's like, okay, well, if you have a big position that goes nowhere for 3 years and the market's going up in a straight right line, it's just hard to tell people you're underperforming, even if the business is getting better. And it's like, no, it's going to work out. It's like, all right.
It is the really difficult thing about value investing within a fund structure, right? And I think it is where this lust for closed capital comes from, just like permanent capital structures really lend itself to the ability to be like, hey, we're looking 3 years out, and like there's some time arbitrage here. I'm pretty confident that this will work. But like, if you have the risk of redemptions, like you said, it gets really hard to do that. But I think, at least from my experience, like my big winners have almost all taken time to play out, right?
Yeah,
like,
as they should.
Like Cypher Pharmaceuticals, when I was buying at 3, I think sat there for 1.5 years, right?
Oh, really?
Yeah, I think it was oh, like not much happening, but it was like, I was kind of looking at it and being like, what am I missing here?
Yeah.
And then it does often take a catalyst, and this goes back to the buyback thing, right? Which, Einhorn was talking about in his letter, I think a couple quarters ago, where you might not get the incremental buyer, and so like having that return of capital is increasingly important. And I think what happened there was they announced a buyback, and that started getting people involved, right? And it's something, that capital return variable is something I've been prioritizing a lot more recently.
Yeah.
Whether it be dividends or buybacks, I just think it helps you deal with the kind of like the schizophrenia of the market in the short term sometimes, right? Like, just if no one cares, like it can be very frustrating to just sit on dead money and be like, this is a really good idea, but it's not going anywhere. At least if you're getting some yield out of it, it helps, right? Even if it's a buyback and you don't see that today, it quells your anxiety that like one day this will work, right? Like if you buy something 3 times free cash flow and they're buying back stock, it's very hard for that to not work if that cash flow is sustainable, right? Like, there's just going to be no shares to buy at some point, right? So
yeah, that's right.
I've been.
And if there aren't, you do a big special, and then everybody parties.
Right. I feel like management teams, maybe it's just the sectors that I'm spending time in. I feel like they're becoming more sensitive to this need as well. Maybe that's pressure from shareholders, right? Or just certain capital cycle dynamics. Like if you're investing in commodities and stuff, and you've watched governments kind of shut your business down and whatnot. You're like, right, I own a lot of coal companies, and like that's one sector where it's like, hey, we have low multiples. The future of the industry is really in jeopardy. It's probably never gonna we're gonna be shuttered pretty soon. So let's just start buying back the stock. And in a large respect, they have it re-rated, right? Like Peabody Energy trades at some ridiculously low free cash flow multiple. And they just had an activist actually file a 13D today with some proposals, right? And almost all of those are like, let's get the buyback going really hard here. Because if you're at 4 times free cash flow and you start like just hammering the bid on your own stock, and anyone who isn't, I think, plagued by sort of environmentalist ideology can understand that coal isn't just going to disappear in 5 years, right? Like, sure, it's declining, but so is the supply. And, you know, if you just can somewhat sustain this cash flow and buy back your stock, like, it's going to go up.
Yeah.
But the question becomes, how long do you have to wait? But I don't know. I think time arbitraging stuff like that is a really nice place to be looking.
I quite agree. You always have the risk in like coal, in theory, the terminal value is zero, but I would argue that terminal, when that zero may come, is it's much longer than probably most people might think, right? I mean, all you have to do is look at any forecast.
Certainly further out than it's being priced in, right? Like,
yeah.
Yeah.
So you don't want to buy in to when that terminal value occurs. But if you can do it when the market implies a shorter duration than is reality, you can get some really nice returns.
Right. Yeah, 100%.
We'll see. But I've enjoyed this. I'm going to get you out of here on time, and also the editing goes by the minute, so I like to keep them under 2 hours. But I appreciate you stopping by, man. It's been a fun conversation. One of the things that I really liked about this podcast when it was small and I didn't think anybody listened is I got to feature a lot of guys like yourself and have conversations that I was not like as concerned about, I guess, like people listening. And I'm glad that you went where you went with it. I hope anyone that heard any microcap names understands the risk. And, should they buy and sell and liquidate, they're probably liquidating to you. So beware of the risks. But it's been nice to have one of these kinds of conversations again. And I'm glad that I did it with you. Thank you for what you contribute.
Well, thank you for having me, Bill. This is
man.
Great time. Great conversation.
Yeah. Maybe we'll do a space sometime.
Yeah, that'd be awesome.
All right, cool.
All right.
Thanks again and have a good day.
Cheers. Thank you.
Absolutely necessary.